And welcome to Lecture 14, Noise versus Signal. And we're going to get into consolidations and trending from a different perspective, more quantitative perspective. So let's start off by defining what exactly noise is. So we can think of noise as the erratic movement that surrounds a price's underlying direction. High noise would be like a drunken sailor's walk, like we talked about in the random walk lecture, where it's just sort of mindlessly going up and down. And low noise is something that's very smooth and has a clear directional bias. Our job is to avoid high noise because it creates false signals and stop-outs and prematurely knocks us out of trends due to fake-outs. So here's a great example of what high noise looks like. You know, a large amount of oscillations with relatively little directional bias, very similar to a consolidation period. Here's medium noise, which is slowly trending here. You can see as an upward bias, but still so much oscillation around it that it's hard to actually hit this trend. And finally, low noise, where we have a very clear directional bias with still oscillation, but a relatively low amount of oscillation compared to the trend. Here's an example of orange juice futures, and we can see that this trend is fairly low noise. Right? We have a nice smooth upward price bias. It gets a little choppy in here, but for the most part, this is a pretty smooth upward trend, something that we would be able to hit and profit off of if we were trying to trade trends here. On the contrary, here's USD CAD, that FX cross, and you can see how much noisier this trend is. So yes, we did start around here and we ended up here. So this chart did have a upward directional bias, but look at all the chop we had in between from there to the right side of the chart. So this is a much harder market to trade, and we generally want to avoid trying to play trends that have a large amount of noise because it's very easy to get faked out of them and take losses. So consolidation periods, the points of equilibrium, are considered high noise periods for directional traders because price is bouncing back and forth like the drunken walk. It's very noisy, it's very efficient, and we don't want to be taking risk in these particular situations. We want to bucket our risk into predictable trends. So here is a chart of the US dollar index, and you can clearly see here what are areas of high noise and consolidation versus trending. So obviously in this area over here, we have very little directional bias with high noise. And then right here, the market completely changes character. And we have a very clear directional bias with very little noise. And then it returns back to this more noisy consolidation sideways again. And this oscillation between high noise consolidation to trend and back to high noise consolidation is the natural progression of markets that we talked about with the two parts of price action, either being in a consolidation phase or a trending phase, and price moving from one to the other. So this back and forth between these two states is very common, and we want to focus on the points that are trending. Here's a little funny video that Ed Sakota, the famous trend follower, recorded about whipsaws. I just want to play it for entertainment here real quick.
Hi, I'm Ed Sakota. And you get a whipping, I get a saw, honey. You get a whipping, I get a saw, baby.
Yeehaw!
You get a whipping, I get a saw. One good trend pays for 'em all, honey trader, baby mine. Now,
So that was a pretty funny tune that he made with his little band there. I recommend you guys checking out the video, the full video. But he's talking about how the whipsaws, the high noise areas, are what causes trend followers to lose money, and they make all their money back into clear trends. So another way to talk about this trending versus consolidation is smooth versus rough. And we want to look at smooth areas of the market. Like think back to that Dixie, that dollar index. It was a very smooth trend. So more noise is going to cause more whipsaws. And a few clues that we can use to help us avoid noise is first looking at the chart and seeing if it has precedent for having smooth moves. So we don't want to see candles with spindles or very erratic price movements in the history of the chart. We want to see something that's generally moving in a smooth fashion. So for example, this chart, look at all the spindles. See the little tiny wicks that come out of these candles indicate high noise. And for whatever reason, the characteristic of this market trades is such that there's going to be a lot of backing and filling. And this makes it much harder to trade and much more likely to generate losing trades and stop outs. Versus something like this, we can see the moves are a lot clearer. So we don't have all those little spindles like we saw in the last graph, it's much smoother and we can see much more clearly defined movements. This is a type of chart that's going to be much more conducive to paying us out when we take a directional bias on it, instead of the other one, which is a lot of back and forth and frustration. Again, this is another good example of a clear, smooth, trending market. This is NVIDIA Corp. And you can see there's not many spindles. There's very clear directional bias and smoothness in the way that this thing is moving. It's not going all over the place and chopping around like a drunken sailor's walk, in this type of fashion where it's just straight sideways with up and down. It's very nice, clear, smooth movement. So these are the types of charts that we want to be focusing on when we're looking at what universe that we want to trade or what stocks or assets that we want to research deeper for potential executions. So a way to quantify noise in a chart, we're going to get a little more quantity here, is called the efficiency ratio. And this comes from Perry Kaufman's book. And it's used to calculate the level of noise in an asset. So if you prefer doing a calculation over just looking at the chart, here's the method we can use. So the closer to 1, the more efficient the trend with less randomness and noise. So the efficiency ratio is defined by having a net change in price as a positive number over the sum of individual price changes. So it's a fairly simple calculation to make, and it's very effective at telling us from a quantitative perspective how much noise is in the market. So let's run through a little example here demonstrating how to calculate the efficiency ratio. So let's say we have a stock that goes from 1 to 10, and the path is 5, down 2, up 4, down 2, up 4. Now let me draw this on here really quick so it's easier to tell. And up 4. So we went from 1 to 10, and we got that by going up 5 minus 2 is 3, up 4 is 7, minus 2 is 5, up 4 again. So we traveled a total of 9 points. And then we add up the total amount of swings to get the denominator. So 5 plus 2 is 7, plus 4 is 11, plus 2 is 13, plus 4 is 17. So our denominator is 17. And then we make that division, and we get an efficiency ratio of 0.529. Now let's take the same stock where we travel from 1 to 10, but in a noisier path. You're going to see here how we get a lower efficiency ratio. So let's, instead of the last one, maybe we go up 4, down 2, up 4, down 2, up 4, down 2, up 3. And let me label them on here again so it's a little bit easier to tell. So we move a total of 9 points again from 1 to 10. 4 minus 2 is 2, plus 4 is 6, minus 2 is 4, plus 4 is 8, minus 2 is 6, plus 3 is 9, so that checks out. And then we have to add up the total amount here to get the denominator again. So 4 plus 2 is 6, plus 4 is 10, plus 2 is 12, plus 4 is 16, 17, 18, 19, 20, 21. So now we have a larger denominator, and therefore our efficiency ratio is 0.4285. And that's lower than the previous example that had less swing. So this is how you can quantitatively define how noisy a trend is, by adding up the amounts of the individual swings on the way from the starting point to the ending point. So liquidity, activity, higher amounts of that are equated to higher amounts of noise. So this is a great thing to keep in mind when you're browsing the market. Deeper markets are going to have more players competing. So they tend to be a little bit harder to find very, very smooth trends, whereas less market participation leads to less efficiency and smoother, more obvious trends. And this is also true of individual stocks. So large caps will tend to be noisier than small caps. And that's because fewer investors are trading, the micro caps and little forgotten about stocks, and everyone is trading those big large caps. So we see, when you run the numbers, we tend to see more noise in the more participated markets. So you can see here, as North American equity markets matured, the efficiency ratio went down. And this buckets out, the efficiency ratio in 1994, 95, 99, 2000, 2004, etc. And this efficiency ratio went down because the market started to get more participation, more volume, and more players. Now, here's a chart of efficiency ratios for Asian markets. And again, this checks out as well because look at the markets with the lowest efficiency ratios. That's Japan and the Nikkei and the Topics. And then the ones with the highest are these very newer markets, Pakistan, Vietnam, Sri Lanka, etc. So those have much less participation, much less competition, so they tend to have smoother directional moves. So keep that in mind when you're looking through all the markets. The older, more developed ones, the ones that are more participated on, have more competition, are going to be more noisy and more mean reverty, whereas the newer ones, the frontier ones, should have clear directional trends.